Even profitable law firms can be on the brink of collapse. And here's the reason why.
Welcome to the Lawyer Millionaire Podcast, the show where law firm owners learn to build wealth, scale their firms, and design the life of freedom they deserve. Hosted by Darren Wurz, business and wealth advisor for law firm owners and author of The Lawyer Millionaire, this podcast delivers the strategies and inspiration you need to break free from the grind and become the financial success you envision. Let's dive in.
Welcome back to the Lawyer Millionaire Podcast. I'm your host, Darren Wurz. Quick note before we dive in. What we're discussing today comes straight from Simple Numbers by Greg Crabtree, which we're reading right now inside the Lawyer Millionaire community. And if you're not yet a member, you're missing out. Join over 100 other firm owners getting scientific and intentional about profitability in 2026 at community.lawyermillionaire.com. It's free. The link is in the show notes. Okay, if your law firm is running below 10% pre-tax profit, you might be in trouble. Greg Crabtree's argument in Chapter 2 of Simple Numbers is one of the most useful reframes that I've ever seen. He says that 10% pre-tax profit isn't your goal, it's your new break-even. You need at least 10% pre-tax profit to have a sustainable business. Breaking even isn't sustainable. Even 5% isn't sustainable. 10% is the floor. Okay, before we go any further, though, let's clarify what pre-tax profit really means. Pre-tax profit is what you have left after every real cost of running your firm, including a market-based owner salary, but before income taxes. So it's revenue minus operating expenses, minus depreciation, minus interest on any debt. What's left is pre-tax profit. Now, you might be thinking, if you're business savvy, Darren, isn't that just EBITDA? Well, not really. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a big accounting term that big companies love because they get to add back interest and depreciation when they're shopping a business to investors. But for small businesses, you should not add those things back. Why? Because they're real cash costs. Interest on a merchant loan or line of credit hits your operating account every month. That's real money. You don't get to pretend it didn't happen. Bottom line, pre-tax profit is the honest number. It's what is actually left after the firm has paid every real cost. That's the number we're measuring. And here's why this matters. Below 10%, you're not just behind on profit. You are structurally too thin to fund growth, to absorb a bad quarter, or to hire. But once you adopt 10% as your floor, decisions get easier, pricing gets braver, hiring gets more certain, saying no to bad clients gets easier. We talked about that on a recent episode. Now, why should you care about this number so much? Well, most law firm owners that I talk with think that hitting any positive number on the bottom line means that you're winning. You're not. And too many law firms are running on razor-thin margins and may not even know it. And look, it's easy to let that happen. Most of us fall into what I call zero-sum thinking. It's easy to do. We look at our business and we think, oh, look, I made $500,000. That means I have a budget of $500,000. Wrong. You need to leave room for profit. You need to actually budget for profit. And that's separate from your salary, by the way. If you're not leaving room for profit, you are in trouble, even if the bank account looks fine. You wear two hats every single day inside your firm. The first hat, you're the practitioner, working in the business, and even working on the business. those really are very similar. You're trying cases, you're drafting documents, you're meeting clients, you're managing your team, you're tinkering, you're doing things. You're at work. The second hat, you're at home, sipping a Mai Tai. You're the investor, the owner, the person who put capital and risk on the line, the person for whom this is just part of your portfolio of investments, and the person who deserves a return on that investment. Profit is about the return, and profit is the return on the second hat. It's the dividend check that the investor in you should be collecting. It's over and above a reasonable market wage for the work you do as a practitioner and CEO. If your firm isn't cutting that dividend check each quarter, the investor in you should be furious because you are not getting ROI. And here's what's worse than having no profit margin: continuing to have no profit margin as you grow. Let's think about it. More revenue, no additional profit. That just means you're working harder for the same money. Well, that doesn't make any sense. You're hiring more people, taking on more files, dealing with more chaos, and ending the year in the same place. Excuse me, but that's not growth. That is maybe a more expensive treadmill, and that's misery. And this is why we've got to redefine the breaking point, the break-even point. 10% minimum, no exceptions. Otherwise, you are really on a fast track to burn out. Let's make it real with real numbers. There's a line in the book I want to repeat because it's really, really good. And it is this: revenue is for show, profit is for dough. An example of this is a $20 million construction company where 90% of the revenue gets passed off or eaten by materials and subcontractors. That's really only a $2 million business with a giant top-line number that means nothing. So let's be clear. Revenue is meaningless. Say it with me now. I don't care about revenue. What? Let's look at a law firm. Imagine a $1.5 million firm running at 5% pre-tax profit after market-based owner salary. That's $75,000 of real profit over and above your salary for the year. Now, subtract taxes, let's say 40%, and you're left with $45,000 of retained earnings for the entire year to fund growth, to weather a bad quarter, to build core capital. And that's not enough. Now let's juice it up a little bit. Same $1.5 million firm doing 15% pre-tax profit instead of 5%. That's $225,000 of real profit. After taxes, about $135,000. 3 times the retained earnings. Now you're in a good place. Now you can hire that associate. Now you can ride out a slow quarter without panicking. Now you can fund your core capital and build your emergency reserves. Now you can take a real distribution and not gut the firm. That's a big difference. And the difference over a long period of time, like let's say 10 years, could literally be millions of dollars in your pocket, in retained earnings, and in what your firm is actually worth to an outside investor. Let's get concrete. So, here's Crabtree's framework from the book, Simple Numbers, 3 benchmarks, easy to remember. Write these down if you're not driving. 5% or less of profit means your business is on life support. You need to fix things now, or it may never wake up. Okay? The patient is critical. If you're at 10%, okay, you have a good, solid, nice, sustainable business. 10% is the new break even. That's the minimum. We've got to get there. If we're below that, we're not profitable, not truly profitable. The third benchmark is 15%. If you're at 15% or more, you have a great business. And these benchmarks can be really useful to you in the hiring and investment cycle. Here's how it works. When your firm is running at 15% pre-tax profit, you've got the cash cushion to be able to hire. You can afford the new salary and the dip in productivity that almost always comes when someone's ramping up. The new hire is going to drop your profit margin temporarily, maybe back to 10%, maybe lower. That's okay. If you started at 15%, because now you're starting from a good place. And now your job is to grow that hire, get them productive, build them up in the firm, and as they ramp up, your margin climbs back towards 15%. Then you do it again. Get to 15%, higher, drop down, grow back, higher again. That's the rhythm of a healthy firm scaling profitably. And yes, you can be profitable the entire time you're scaling. A lot of times owners reverse this. They hire first before they're profitable, maybe when they're even below 0%, hoping that revenue and profit will follow. And then they get stuck. So, get profitable first, hire second. The math works that way. Now let's go a little bit deeper. There's 3 things that firm owners often get wrong about this framework. First, and there's one caveat that we need to add. The first thing is that if you're a smaller firm or a solo, you may actually need a much higher profit margin. If you're a solo, you should really be running at 30% or higher. Why is this? Because at a smaller scale, you need a much bigger cash cushion to weather a bad month or fund a future hire. There's no reserve of an army of associates that can absorb the difference. It's just you. So your margin has to be fatter to compensate. As you grow, the percentage will decline and can decline, but the dollar amount grows significantly. A $5 million firm running at 15% is generating $750,000 of pre-tax profit. A $500,000 solo firm running at 30% is generating $150,000. Different percentages, but each one is healthy for that scale. Number 2, second thing most owners get wrong is that they think they can't be profitable until they get bigger. Wrong. You can be profitable at every stage of growth. There's no revenue level where 10% suddenly becomes possible. It's a discipline you build in early. Otherwise, you just continue the bad habits as you scale. And third and last, and this one is really helpful, there's one stage where staying profitable does really get genuinely hard, and Crabtree calls it the black hole. What is the black hole? The black hole is the zone between 1 million and 5 million in revenue, maybe a little bit higher if we adjust for inflation. Why? Because in that zone, your firm has outgrown your ability to run every function. You are definitely forced to make some hires, and those might be COO, salesperson, marketing, operations, IT, finance, customer service, HR. You've got to fill these roles. Without 10% plus pre-tax profit, you are not going to have the capital safety net that you need to staff up. So, if you're not there, what ends up happening? Well, you hire on the cheap, you get bad people, and we all know that that is a recipe for disaster. Or you stretch out good people until they've truly burnt out. So, we need to get profitable first, hire second. Always. If you're not profitable and you try to hire your way out of it, you're not growing. You are scaling a problem business, one that you might actually end up having to scale back. You're just multiplying inefficiencies. You've got to fix the business first. Get profitable, then hire. Okay, so here's what I want you to do this week. Pull up your last 12 months of revenue, subtract a real market-based owner salary, what you'd have to pay someone to replace you if your salary isn't already there. Then subtract every other expense, including interest, and whatever's left, divide by revenue. That's your real pre-tax profit percentage. If it's under 10%, you've got some work to do. You might need to raise prices. You might need to cut non-productive expenses. Figure out what's truly not working in your business and address it head on. Look at every line item, every hire, every vendor, every recurring charge, and be brutally honest. Don't try to fix it by chasing more clients. That's the trap. Fix it with margin first. Once you're north of 10%, your next dollar of revenue compounds because there's margin underneath it. Below 10%, every new dollar just funds the leak. You're bailing water faster, not patching the boat. That's a great analogy. Now, here's why this matters so much to me personally. You know, I've been there and done that. There's a lesson hiding in this episode. It took me a long time to learn. You do not have to take on debt to grow. And if you do, you should be asking some really tough questions. If you listened to last week's episode, our interview with David Holmes, you saw an example of a firm owner growing without debt. So if that marketing company is telling you, oh, don't worry about it, just put it on a credit card or take out a loan, it'll all pay for itself. We really should be thinking critically. If your business is sick, you're just making it sicker by trying to grow. It's like trying to build muscle at the gym while you have the stomach flu. You've got to get healthy first. Then you can grow. Profit margin is health. Get to 10%. Then you can think about growth. Actually, get to 15%. Okay. Now, here at The Lawyer Millionaire, this is one of the 4 numbers that we coach firm owners to track and forecast every single month and really every single week. We help you build the systems, the dashboards, the rhythm that help you keep real pre-tax profit visible so you can stop guessing and start making decisions on math instead of feelings. And then we help you translate that into real after-tax wealth so you can achieve financial independence, retirement, FU money, whatever it is you're going for. The number isn't the goal. The freedom on the other side, that is the goal. If your real pre-tax profit is under 10% and you've been telling yourself, hey, it'll get better after the next hire or when the next big matter closes, let's pause. Book a call with me at lawyermillionaire.com and let's figure it out together. Don't run another year on hope. Get the math on your side. There is a pathway, friend. And all quarter long, we're going deep into simple numbers inside the Lawyer Millionaire community. Come join us. The link is in the show notes. Well, that's it for today, friend. And remember, if your law firm isn't building you wealth and freedom, what the hell are you doing? Can I get an amen up in here? Now, go make it happen. And I'll see you next.
Are you a law firm owner looking to build real wealth and break free from the daily grind? On the Lawyer Millionaire podcast, we share practical strategies to grow your practice, maximize profits, and create the financial freedom you deserve. Join host Darren Wurz as he interviews top experts and successful law firm leaders who share their secrets. Don't just practice law, build a legacy. Listen now to The Lawyer Millionaire wherever you get your podcast. The Lawyer Millionaire podcast is for informational and educational purposes only. It is not intended as legal, tax, or investment advice. Listeners should consult with a qualified professional before making any financial or business decisions. The views expressed by guests are their own and do not necessarily reflect those of Darren Wurz or Lawyer Millionaire Wealth Advisors.